Our outlook remains broadly positive because in the baseline we're still seeing very strong growth, particularly in the US, but also in China and Europe stabilizing. But there are also a wider range of possibilities for these growth outcomes. And we're also seeing tighter financial conditions, which are creating a challenge for a number of asset classes. And as a result, we think it's a good time to start building resilience into portfolios. So it's certainly not as rosy a market outlook as we had in 2017.
What does that mean, building resilience into a portfolio? How do you do that?
Right. So if you look at our quality time chart, one way of doing this is to focusing on quality stocks, the stocks of companies that have very strong balance sheets and strong earnings growth. So you still get the upside from having that equity exposure, that equity preference, but you focus on companies that will do better if we see a further tightening in financial conditions and more uncertainty in the outlook.
Isabelle,
that's one way of doing it.
Excuse me, focusing on quality companies, those with fast earnings growth and strong balance sheets, it sounds like kind of a prudent conservative thing to do. However, doesn't it bring you to a place where you're actually, in the U.S. anyway, buying the very largest stocks of the NASDAQ in technology where you've already had great performance? And I wonder what that also means globally to have a preference for quality.
So you're absolutely right. At this particular point in time, there's actually a very strong correlation between the quality stocks and the momentum stocks, the ones that have been doing well. And in fact, we do also still retain this preference for momentum stocks. And from a global perspective, you're absolutely right. That does mean an overweight position towards the United States, which right now is our most preferred stock market, because that's simply where we see the strongest potential for earnings growth to outperform. But we also like emerging markets equities, which should continue to do well, again, in the baseline scenario where we can avoid going into a full-blown trade war without further escalation without meaningful further escalation from where we are here. So you're absolutely right. We do have a preference for U.S. stocks right now, but we also like emerging markets.
Isabelle, just in terms of the risks, you mentioned the potential for trade war as being one of them, but you also talk about growth overheating. Are you talking specifically about the United States market with that?
So you're absolutely right. We're now facing a situation where there's higher uncertainty about growth outcomes, both on the upside and on the downside. So the trade war is obviously the downside risk part. But as far as the U.S. goes, and yes, you're right, this is a very specific U.S. concern, there is a possibility of overheating, which would then force the Fed to tighten the brakes faster than anyone expects and bring the end of the cycle perhaps sooner than we'll anticipate. Now, on this front, I have to say the news we got on Friday on the labor market front suggests that we shouldn't be too worried about this overheating scenario. But, you know, we're only halfway through the year. There's still a significant amount of fiscal spending having to come through the pipes. And so this overheating scenario is one that definitely needs to be kept on the radar screen as a tail risk, if nothing else.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.